Good afternoon. Today I am going to start ratio analysis. Part B. Ratio analysis. What do you mean by ratio? A ratio is an mathematical expression or relationship between two related items or group of items expressed in quantitative forms, that means in rupees, values, okay, not qualitative. In simple sense, a ratio is simply one number expressed in another numbers. Say two numbers are given, x and y, but it should be represented in the ratio x is to y, x by y, or x by y into 100. Generally, ratio in their three form. Number one, pure ratio, that is simple ratio or proportionate. Say gross profit and sales. Gross profit is to sales. Point number two, rate or so many times gross profit by sales, indicate times, that is 50,000 by say 2 lakhs, that is equal to 1 by 4 equal to 0.25 times, okay. And then percentage, x by y into 100, say gross profit by sales into 100. But what do you mean by accounting ratio? Accounting ratio are those that are based on the financial statements and expressed an arithmetical relations between various accounting variables, okay, that is known as accounting ratio. Accounting ratio is the mathematical relationships, a study among the various financial factors in a business as disclosed by one single set of statement and a study of trend of these factors as shown in a series of statements, that is known as accounting ratio. Now there again theory portions. What are the objectives of ratio analysis? Now objectives of ratio analysis may be divided into their or accounting ratio. There are so many types of accounting ratio, okay. First ratio, that is the main objectives. Number one, identify their problems area. Number two, their measures profitability, and also there highlights the change in the form from time to time. Another also their objectives to determine their operational efficiency, again also to find out or assess the business solvency. Another objectives, it facilitates comparative analysis. Comparative analysis means a comparison between present performance and past performance, and that between self and other firms of the same industry, okay. Now next, another also objectives, aids in budgeting and forecasting for the helpful in the budget or forecasting purpose. That is a very important. Also they are again objectives of ratio analysis. Another objective, simplify accounting figures. That means a major objectives of financial analysis is to sort or summarize or organize and properly arrange the financial matter so that in case may be easily absorbed by all, okay. Now next again, what are the limitations of accounting ratio? This is also they are important for theory person. That is the main limitations of accounting ratio. Number one limitation, false accounting data gives false ratio. Another limitation, ratio analysis becomes less effective due to price level changes. Price level changes also they are very important. That means price level changes in the figures in the past years must be adjusted in the light of price level changes before the ratio for these years are compared also. Another limitations, ratio may be misleading in the absence of absolute data. Another limitation use of a single ratio. What do you mean single ratio? That means the analyst should not merely rely on a single ratio. He or she should study several connected ratio before reaching a conclusion, but not find out their current ratio, quick ratio, gross profit ratio, net profit ratio. That means so many ratio are analysis, then their analysis or judgment. Again also there are another limitation, window dressing. Window dressing means some companies in order to cover up their bad financial position resort to window dressing. Okay. Next, lack of proper standards. That means circumstances differ from time to time or firm to firm, hence no single standard ratio can be fixed for all the firms against which the actual ratio may be compared. And another main important limitation, ignores qualitative factors. Ratio only discuss the only for quantitative figures, but ignores qualitative factors. It ignores qualitative factors which are also essential for the interpretation. Another limitations, ratio alone are not adequate for proper conclusions. Ratio, that means ratio derived from analysis of standards are not sure indicators of good or bad financial position and profitability of the firm. These are the main limitations of accounting ratio. Now next again, classification of ratio analysis according to our syllabus CBSE class 12, that is the classification of ratio may be divided into 4. First point, that is the liquidity ratio. Number 2, solvency ratio. Number 3, turnover ratio. And number 4, profitability ratio. What do you mean by liquidity ratio? Liquidity ratio are those ratio measures the ability of the firm to pay its current liabilities in time. Okay, that means these ratio are used to assess the short-term financial position of the firm. Therefore, these ratio are also called short-term solvency ratio. Solvency ratio again also they are subdivided into 2, current ratio and quick ratio. Okay. Now next, solvency ratio. Point number 2. These ratios are calculated to ascertain the ability of the firm to pay its long-term liabilities. Long-term liability. Solvency ratio ensures the long-term financial position or stability of the business. This ratio again also they are subdivided. This is the solvency ratio. Number 1 again subdivided, debt to equity ratio or debt to equity ratio, total assets to debt ratio, proprietary ratio and interest coverage ratio. Point number 3, turnover ratio. Turnover ratio or activity ratio. Turnover ratio means these ratio are also performance or activity ratio. This ratio indicate how efficiently and profitably the total capital, working capital, fixed assets and other inventory of the business are used. This ratio again also they are subdivided, the turnover ratio, inventory turnover ratio, debtors turnover ratio, creditors turnover ratio and working capital turnover ratio. Point number 4, profitability ratio. Profitability ratio means such ratio measures the various aspects of their profitability or the capacity to earn a stable return of a business firm. This is the profitability ratio. Profitability ratio are those types of ratio calculated. Number 1, that is gross profit ratio. Number 2, operating ratio. Number 3, operating profit ratio. Number 4, net profit ratio. And number 5, return on investment ratio. That means this is the classification of ratio divided into 4. Now next class discuss in details what is the meaning of liquidity ratio, again their formula, important significance, and there another solvency ratio, turnover ratio and profitability ratio. Okay, thank you.